Yo, it's your boy Felix, and welcome back to another interesting episode on Top of FX. And I want to wish you guys a happy new year, and I hope you guys had an interesting and fun celebration. So, now without further ado, let's jump right into the topic of today. And today, I'll be analyzing the Nigerian Aviation Handling Corporation PLC. In case you want to read more about the company, to get more information about the company, you can go to the company website, and on the website they have the company profile where you can get more information about the company, the vision and mission, the core values, and some other things. It's rich in information. But right now, I will be focused on analyzing the technical aspect of these public assets, which is listed on the Nigerian Stock Exchange market. So let's see what's happening. So the first thing I always do is we're going up to the highest time frame. In this case, I am on the monthly time frame, which is the 3-month time frame, and trying to see what has been happening. What's the market doing? Is the market making higher highs, higher lows, or lower highs and lower lows? And you can see for some time the market has been making down here, was making lower lows and lower highs. So this is a high, and this is a low, this is a high, this is a low, this is a high, this is a low, this is a high, this is a low. So lower lows and lower highs. And one thing you need to know is that, like, whenever you see a high like this, where the high never got broken, you can see the high was never broken, all the highs never broken. It meant that a lot of big banks, large financial investors, commercial banks, that was where they placed the order. So they placed the order around here. So they sold the market at this area, at this level, at this level, and at this level. So what that's caused from that action is that there's a lot of liquidity placed around this area. So liquidity placed down here, liquidity placed down here, and you have some money down here, and money down here. So, imagine the big banks down here. This area, this was where they shut the market. So they have a lot of order. There's an order block. So there's a lot of money down here. So at major swings, you have a lot of internal liquidity in the market. So the market was making lower lows and lower highs. So, and none of these highs ever got broken. So guess what happened? So if I'm to delete everything down here now, yeah. So it's making lower lows and lower highs, lower lows, lower highs, lower lows, lower highs. So what happened? We were to expect a lower low and lower high. But what happened? The market came downwards, broke through this area, this was the last high the last lower high made. So what's coming after this is meant to be a lower high. So instead, the market came, broke through this lower high, and kept on going upwards. So because you have a lot of money around this area on these major swings are high, the market came upward and took out all the liquidity resting around this region. And the reason why you have liquidity has to do with the following reasons. The big banks, commercial banks, central banks, large financial investors, all these rich guys that place billions of trades daily on a daily basis, they all have their stop loss placed around this region. So imagine you place a very large trade, you also have a stop loss placed around this region. So that also contributed towards liquidity. And secondly, you also have traders that are hoping that the market breaks through this area of resistance. So they have a buy stop place around there. So around this region, you have money, a lot of money down here, down here, down here, down here. Because a lot of retail traders, they think that when the market breaks through an area of resistance, then the market is going to head for an upward move. So definitely they have a lot of money placed around here. So that's created a pool of money around this area. So what you have is a trend line liquidity. So there's a pool of money around this area. And at this area down here, this was where the company released the IPO. So that was when they went public. So around this level, you have a lot of investors because this was when the IPO got released. So there's a lot of money resting around there area. So you can also call it an external liquidity because the market began falling from here, which led to the break of several structures down here. So you use an external liquidity in the market. So you have a lot of money resting down here because So at this level down here, you have external liquidity, because this was where the asset went public. So basically, the IPO was announced or was released around this area, which was in 2013 and thereabouts or so. So meaning, like, you have a lot of investors. The bulk number of investors should be around this area, because a lot of people were hopping on the trade because they had so much expectation of this asset. But unfortunately, what came after that was like a massive fall in the market. A lot of these guys that bought at this region were at loss at this area, and also large investors, bankers, commercial banks, and all these big guys, these big players that invest billions of dollars on daily basis at this area down here. Before they take a sell trade, they always make sure they buy first before they take a sell trade, because the reason for them buying is because they have to get a very good entry level into the market, and that's why you have this down there. You can see this long wick scan down there, meaning the buyers tried to push this market upward, but they couldn't do that any further. So they bought before they sold the market. So meaning, even if they were in profit down there, they had an open position which was at loss. We are currently in this area that broke a structure. So one thing to know that when the market breaks a structure, it will always go in direction of that direction of structure it breaks. So in this case, it broke this structure on the upper end, so it's gonna go down, grab the whole morning resting around this area, a little bit of retracement, and to go upward. Why does a little bit of retracement? Now we're in an uptrend that's making higher highs and higher lows. The other block down here, which is the last bearish candle before the bullish candle, led towards the break of structures, and also led to the break of the external structure, which could see a break of structure down there. So what does that mean is that this is an uptrend, and an uptrend you expect a 5-wave pattern. Already I could see this an area of demand, because this led to the break of the structure down here. So you can see the market came upward. There's the first wave, the second wave, the third wave, the fourth wave, and the fifth wave. So the market is most likely going to come down here around this region, test region, attain a form of support around this region before going upward. Why did I say that? Before the big banks and all these guys took this buy trade position, they first of all took a sell position. You can see this candlestick that went a bit downwards before going upwards. So even if they're in profits from taking this buy position, they had an open sell position that they have to close and have to break even. So that's what they call mitigation. So the bank have to mitigate. So when they have bought this market and has gone to that target location, they will have to mitigate to close their open sell position that you have down there. So what to expect for the market to make like a U-turn? So A, B, C, which is a corrective wave, and at the end of the corrective wave, what to expect is a 5-wave pattern. This. So, but if you take a buy position, if you want to take a buy position, if you want to invest in this, I would say you wait for the corrective wave to be fully developed before you see a form of support around. Let's say this should be your POI, your point of interest should be around this area, because this was an area of demand, and this is where the banks manipulated the market. So obviously the market is going to come down there to test the area of manipulation of the banks. I can go down to the lower time frame to see the fractals properly. Since I'm dealing with stock, I won't really go down to a very low time frame, but at least the main thing is about getting the idea of the market structure and the analysis I'm doing. So you can see so this is the first wave, second wave, third wave, fourth wave, and the fifth wave. So what to expect this? So if you want to take a buy trade, you can wait for the market to fully develop its corrective wave, which is the fourth wave, which is the corrective wave, so which is an ABC pattern. We're currently on the B wave, which is a 3-wave pattern. You can see the A, B, C. If I go to the lower time frame, like the weekly time frame, one thing about this guy, when you start going down, you don't see. So put this in this candlestick. So So I'm on a lower time frame, the weekly time frame, which is an ABC pattern. So this is the 5-wave pattern. The A wave could either be a 5-wave pattern or a 3-wave pattern. I think in this case it's a 5-wave pattern. That is 1, 2, 3, 4, 5. The B wave is always a 3-wave pattern. So what to expect, a 3-wave pattern. So which is in A, B, C. Three-wave pattern. Then what to expect is a C wave. It's a C wave pattern, which is the 5-wave pattern. So at the end of the 5-wave pattern, you can think towards taking a buy trade. But if you can't wait for this, I don't know if you can trade this on some trading platform. So for those intraday traders that want to take advantage of this on the trading platform, they can do that. You can say, okay, since this is an ABC pattern, this is a corrective wave, this C wave down here is a 5-wave pattern. You can take a buy trade, and probably somewhere around there you take your profit target. Or you can say, okay, I'm going to sell this market at the end of this B wave pattern, so you can get your fib retracement to and look for area of discount. So from area of 50% upwards is your area of premium. So you sell at area of premium. So you wait for the market to get your area of premium. So at area of premium, you should look for your POIs around area of premium. What I mean by POI, I mean point of interest. So point of interest is a video I'm going to do later on how to get your point of interest. So you look for other blocks and area of resistance. So significant areas you see on the chart, areas from 50% upwards, your area of premium. So you look for significant areas where you would think that the market is probably going to like get a reversal around this area. So you can wait for these, and you can take advantage of it by taking a sell trade on this C wave, which is a 5-wave pattern. For those that also want to be a long-term investor, that want to buy this trade, you can wait for at the end of this C wave pattern, then you take a buy trade, and your profit target should be at this level also at 7.48. So you can wait for the market to go down, to drop down all the way down to maybe 3 naira or so. Then you take a buy trade with a stop loss down here underneath here. You can say, okay, the market goes below this region, I'm going to like sell my stake in this stock. But as long as the market doesn't go below this region, you buy around this area down here. So let's say you buy at 3 naira, your profit target should be at around 7.66 naira. So thank you guys for watching my video, and don't forget to like, comment, and subscribe. See you guys.